Welcome to today's deep dive. Usually investing in your 20s feels like, strapping yourself to a rocket.
Right, you just buy index funds, accept the wild volatility, and hold on.
Yeah, hold on for dear life and just close your eyes during the crashes. But today, we are exploring a document detailing 5 specific advantages of whole life insurance compared to pure investments like stocks or ETFs, specifically for people in your 20s.
Which is a really interesting shift in strategy.
It is. Okay, let's unpack this, because buying life insurance in your 20s sounds completely counterintuitive. I mean, is it actually a secret financial multi-tool?
Mhm.
Why put training wheels on the rocket ship?
Well, to understand that, we have to start with the foundation of whole life insurance, which is basically what happens when things go wrong in life or the markets.
Right.
Whole life provides a guaranteed tax-free death benefit, whereas pure investments, they only leave behind their current market value.
Which could be down like 20 to 50% in a sudden crash.
Exactly. And furthermore, buying in your 20s permanently locks in low premiums and insurability while you are still healthy. It also has a contractual minimum interest rate.
Wait, meaning your cash value literally won't decline during a market crash.
Yep. What's fascinating here is how this effectively shifts financial risk away from the individual, providing a guaranteed growth floor.
Wow. So it's almost like buying a house with a permanently locked-in mortgage rate that also contains a magical safe that never loses value. But I have to ask, is this level of downside protection overkill for a young person with decades to recover from crashes?
Well, since we've established the downside protection, we really must look at how this vehicle actually grows, how it functions as a living asset over, say, a 40 to 60-year runway.
Right, because you're theoretically holding it forever.
Yeah, exactly. Starting in your 20s allows decades of tax-deferred compounding. Crucially, you get tax-efficient access to this cash via policy loans.
Okay, wait.
There are no credit checks, no taxable income triggered, and the death benefit remains completely intact. Selling pure investments, by contrast, triggers capital gains and permanently removes that money from the market.
Here's where it gets really interesting. Wait, aren't I just borrowing my own money? Is this just a psychological trick?
A lot of people think that, but if we connect this to the bigger picture, you see the mechanics are totally different. Selling stocks permanently kills their earning potential.
Because the money is gone.
Right. Whereas policy loans allow the underlying insurance asset to keep working. You're basically borrowing against it while it still grows.
Oh, wow. Okay, I mean, these guarantees sound incredible, which naturally leads to the ultimate question: what is the actual price tag for this certainty?
Right. The crucial context here is that whole life is significantly more expensive than just buying cheap term insurance and investing the difference in low-cost index funds.
Because that buy term and invest the difference approach
Hmm.
actually produces higher net wealth, right? Assuming those investments are held long term.
Exactly. Whole life is essentially permanent protection plus, well, forced, tax-advantaged savings.
So what does this all mean? Is whole life basically an expensive behavioral guardrail for people who might otherwise panic sell their stocks or just stop saving altogether?
Yeah, I'd agree with that. The pros only shine if you can comfortably afford the high premiums and if you specifically value certainty over maximum potential wealth.
To sum it up for you in your 20s, whole life offers a guaranteed floor, tax-advantaged growth, and locked-in health rates, but at a premium cost compared to a disciplined term and invest strategy.
It really forces you to know yourself and your habits.
Definitely. So we want to leave you with this provocative thought. If a perfect emotionless algorithm managed your money, pure investments win. But since humans are emotional and highly prone to panic during recessions, could the rigid, forced nature of whole life actually be the ultimate hidden asset for protecting wealth from our own bad habits? Something to think about.